name is Dr. Marian Exton. I'm the Dean of the Bridgewater College of Business, and pleased to have representatives from Bridgewater Credit Union here today to talk to you about something that will definitely have an effect on your life. You know, there's not too many numbers that affect our lives, but some can in a really big way. And I was brainstorming for myself this afternoon and thinking, well, what are they? And you know, right away, one that came to mind in the college context is your SAT score, your ACT score. You know, that can really put you on one path or another. And another way, your birth date can certainly, you know, when you're old enough to do something. And then all of a sudden, in modern context, or in current context, I should say, I thought, well, for at least a couple families last week, those lottery numbers certainly had an effect on their life. But one set that has an effect for all of us is your credit score. And knowing and understanding it can certainly have an effect on so many dimensions of your life, which our speakers will talk about. But just real quickly, where you live, what car you can have, what phone plan you have. Employers use it now for certain jobs that it could discourage them from hiring you. And I even read an article where certain hospitals will decide whether they will let you have elective surgery because if they figure you can't pay, they don't want to take the chance. So your health care can even be impacted. And so this will certainly be one of those things that you learn here at Bridgewater that will affect many dimensions of your life in the very short run. And so first we have Mr. Kevin Burns, and Mr. Burns is the Vice President of Lending at Bridgewater Credit Union, and he has 30 years of experience in the field. Mr. Mark Campanelli, who's Vice President of Marketing at Bridgewater Credit Union, and Teresa Heffernan, there she is, who is the marketing coordinator. And so I'm going to turn it over to Mr. Burns.
Okay, thank you very much. I will cover all of these subjects, but I hope that I can go in order, but maybe not. But I will cover them in depth. I have a question to lead this off as I look around the room. Somebody might know, but is anybody familiar with the term on the cuff as far as borrowing goes? No. Okay. When I was growing up, I grew up in Roxbury. I was born in Roxbury, and I moved up to Dorchester, which was a trip for me, and then I ended up living in Braintree for a lot of years. But in Roxbury, we didn't have big Stop and Shops and Shaw's at the time. We had small little markets, and my mother would send me over to Henry's Market and ask me to tell Henry this is what we wanted, but we wanted it on the cuff, which meant we wanted it on credit. The term on the cuff, come to find out, comes from some 100 years back when merchants would wear a sleeve around their arm, and when you came in to buy things, they would write it on the cuff. So that's where the term borrowing on the cuff comes from, even though nobody else knew it except the old man in the group. Anyway, it's a start into what is credit, and that was how people kept track of your credit in the beginning, and it has grown into a gigantic industry which affects, as the dean said, every facet of your life. What is credit? The simplest explanation I can give you, it is what you owe in money to a credit union, a bank, to a utility company, and to your student loan grantor, which I'm sure you're all familiar with. And the other component here is what your credit does to your credit score and how your credit score can affect your life. We'll go into that. But first we'll talk a little bit about what is credit and how it works. The interesting thing about credit is that when you go out into and I'm assuming I'm talking to a lot of people here who have not been out in the world yet, working full-time jobs for a long period of time, and they go out to apply for credit. If you don't have any credit, it's difficult to get credit. That's a little bit tough when you go out there in the world. By the way, student loans are considered credit as a liability that you owe, but they're not considered credit to give you credit with a small c towards applying for a loan. So they don't count when you apply for a loan. So when you go out into the world and you first start attempting to borrow, the question that they're going to ask you is, do you have a credit history, even before they pull your credit report, because they know that you probably don't. Now, having said that, not all institutions or individuals refuse you credit because you don't have any. How many people, if anybody in this room, have received pre-approved credit card solicitations in the mail? Okay, several. The reason for that is they'll grant you credit, and if you use that credit card, they will let you use it at a rate of anywhere from 18 to 23%, because they can afford to take the losses that they know they will in the demographic that you're in by charging that interest rate. So just to qualify, when I tell you that most places, reputable places that are doing you a service by providing you a credit card, probably like us, 9.9, 9.99, or somewhere in that range, are not in the same category. So they can afford to take the losses when they're charging you 18 to 23%. My advice would be, if you want to keep your credit score, which will get you in a good range, don't take advantage of those pre-approved credit cards, no matter what perks or rewards they come with. They're very dangerous to start out with. The better way to go about that, to put in a little advice, is to get a co-borrower for yourself. A parent, a friend, a guardian, a brother, a sister, a relative with some credit background to get you established with credit, rather than take the 18% credit card, because it's not going to really help you out in the long run. You'll find it difficult just to make the interest payments. And I think that if you pay the minimum payment on a $5,000 balance, it will take you over 20 years to pay it off. And I think that's being conservative. So most of it goes to interest. What type of credit is out there? As I mentioned, student loans. You have a secured loan. A secured loan is something that you'll probably all be familiar with if you're not already, and that's an auto loan. It's secured by some type of collateral. An auto, a home. It can even be secured by your own money. You can borrow against your own money. That's another way to establish credit. If you have $1,000 in the bank or the credit union, you can borrow against it. You pay a minimal interest rate for that, and it does begin to get you on the line, on the road to establishing some credit. As I mentioned, a mortgage. Somewhere down the road, you're going to apply for a mortgage, most of you in your life, and that is called a secured loan. The thing that I mentioned earlier about the interest rates is something that you want to keep in mind, because there are usury laws, and usury laws are to prevent what they call abusive lending practices as far as the rates go. Yet the usury laws in states allow interest rates in excess of 20% in some cases. Surprisingly enough, as an example, in Alabama, the maximum rate, they call it the usurious rate, is 8% that they could charge on a consumer loan. In Massachusetts, you would think it would be anything below 2 digits, but it's not. It's 20%, which I find amazing. It's 18% on a credit card. Out of state, as I said, they can go up to 23. They're state regulated and they're federally regulated, and I won't get into that. But the rates can be all over the place, and that's something you want to watch out for. Because again, the interest rate affects your payment, which will affect your ability to repay your borrowings or your credit. One of the things you can do also, if you are looking for credit and you have none, is you can try getting pre-approved. And when you're going to get pre-approved, they may call it pre-qualified. They'll do a quick analysis of your assets and liabilities, and they'll try to get you into a loan product, basically an unsecured loan for about $500. If you tell them you want to just establish credit, you might do that. And there are some banks and credit unions that try to offer programs to help you establish credit. At Bridgewater Credit Union a while back, I believe we offered a student loan, not the student loan on the education side, but a loan to students with low, minimal requirements for background and credit history. And you will find institutions that will do that. And again, stay away from the institutions that are offering you the perks in the 18% credit card. So there are all types of credit, and you will encounter them throughout your life. Utility bills are credit. A lot of people, I see their credit. I see on people's credit reports an awful lot that they don't pay their utility bills. I believe that they don't think it's going to show up in their credit report. It does. Medical bills. If you don't pay a copay of $25 to $50 or $100, it can ultimately show up on your credit report. Now, I will tell you that lenders don't pay a whole lot of attention to a couple of things. They don't pay a whole lot of attention to very small amounts on utility bills and on medical bills, on copays. They figured those are disputable items and they're out there, and sometimes it will even say disputable items on the credit report, which I will get to. But you want to pay attention to these things because they are, in fact, liabilities, they are credit, and you do owe them. The other thing that will appear on your credit report is civil judgments. If there's a lawsuit and there's a judgment against you, it will appear in your credit report, and it will have an adverse effect on the decision-making process for the credit. So you have to be careful about that. You also want to keep any documentation that you have regarding a disputed medical bill, utility bill, or judgment on hand so that you can present it, because I do know that credit unions and most reputable banks will take a legitimate reason for not paying a bill. If it's in dispute, they will allow you to present some what we call compensating factors. There is a lot more that goes into credit when you get into the mortgage business, and again when you get into your student loan business. While I'm on it and talking about it, although I didn't intend to focus a whole lot on the particular type of loan, given the environment here, does anybody have any specific questions about student loans and the impact that they have long-term or short-term on your credit or your credit history? Okay. The reason I ask that is that we get a lot of applicants in who believe that student loans are treated like medical bills or utility bills. They're not important if they show up in a credit report as not being paid. That was the case at one time. It no longer is. It's given a lot of scrutiny when it comes in, and it's watched very closely. And that is, I think, going to be a problem for borrowers in the future because of the incredible amount of student debt that is building up in this country. Yes, sir?
Does that include deferments?
No, and I'm glad you brought that up. If you are in a deferment, we don't even consider it. We actually don't consider it in what we call the debt-to-income ratio, which I'll get to later, and that's how much you owe in relation to how much you make. So we do not include that. Yes?
Say I have a few large student loans, but I'm actually making the payments.
Mm-hmm.
Will that adversely affect my credit?
Two parts. If you're making the payment, that's good. That will not adversely affect the credit report or your credit history. But the fact that you're making that payment will be used mathematically in determining your ability to repay. In other words, it'll take out of your disposable income. So if you have a $125 monthly payment, that's $125 less that's considered for use in repaying the loan that you're applying for. Did I make sense on that one? Okay? Yeah. But as long as you're paying it, it's positive. And again, if you're in deferment, we don't consider the loan, and we don't consider the monthly payment until you actually go into repayment. and I don't know, it's 6 months after graduation or termination, involuntary, whatever. But it is something to watch out for when you get into repayment, because several student loans can build up to an enormous monthly payment, which can again affect that ratio that you have when we sit down and say, how much do you make and how much do you owe? And I know there's nothing you can do when it comes to student loans, because I have a daughter in grad school, and she only went for 2.5 years here. She went through a year and a half at Salve Regina. And boy, did I wish that she went here for 4 years. We'd be paying a lot less money. And now she's at UConn, so my house is gone. I have no more house. So, and again, it is very important that you track your student loans during your time as a student, and during the deferment period, and when you get into repayment, to make sure that you're doing everything correctly. Some have, depending on where you get your loan, some have some clauses in there that can elevate or escalate your interest rate. So you have to be careful. You have to also be careful about that on the credit cards that I mentioned. Talk about who uses your credit reports, and some of that was already mentioned. The number of people and institutions using your credit report is growing by the year. Used to be that a bank or a credit union would use your credit score, your credit report, and now you have your landlord using it, you have your employer using it, you have car dealers, you have cell phone providers, you have insurance companies, and you have this recurring use of your credit report for what we call permissible purposes. If you have a relationship with any one of those that's ongoing, they can go in and they can pull your credit report at any time. And again, if you have a relationship with them, particularly if it's a loan relationship, not like a landlord or a cell phone where you have a contract or a lease, it can affect your interest rate and how that moves when they pull the credit report in the middle of your term. So you have to be very careful. You may go in and get a loan for 8 or 9%. They pull your credit report after a year. If your credit score has gone down, they can adjust your interest rate on that loan. Just to clarify, we do not do that type of thing at Bridgewater Credit Union. And I would also tell you that most reputable banks, including the big bad, I'm not too fond of Bank of America, would not do that, but they find other ways to increase your interest rate, and that's usually if you're late for several payments. They can bump that rate up pretty easily. In most, yes?
Does it hurt your credit, or does it show up on your credit report if you have multiple people checking your credit score?
Yes, with some exception. And if you'll allow me, I'll get to that in a few minutes. And if I don't, come back, because as Mark reminds me, I'm the oldest person in the room and my memory's going. So thank you, Mark. Okay. So I will get to how they determine things, and inquiries on your credit report is one of them. It's called the FICO score. Anybody familiar with the term FICO or Beacon, anything like that? Anybody familiar with the 3 major credit bureaus in the country, even though there are 1,000?
Those are the 3 that are free, right?
No. You get an annual credit report. Yes, but it won't give you your FICO score unless you pay $7.95. And how many people want to get their credit report without their FICO score?
Sorry. My account class, we had to do that, and I pulled it up, and I was like, I can't find my score. I thought there was something wrong with it.
No. Did you see the little thing over to the right that says for $7.95? Yeah. They get you.
It was free, so I thought like you got the one annual. But
No.
it's just everything but.
Under the FCRA, the Fair Credit Reporting Act, it is a requirement that each credit bureau provides you with a free report annually. Somebody forgot to write in that it should include your FICO score. which is the only thing that people really want to know, because it's almost the only thing that your lender wants to know, if they're a credit score lender, and that's something that I'll get into a little bit. So the FICO score is interesting. It has a real long history. I won't go back all the way to scoring, but as far as credit scoring. But the FICO score actually came in the 50s. It's called the Fair Isaac Corporation, and it was actually two individuals, Bill Fair and Earl Isaac. I always thought Fair was sort of something to do with fair lending, but it's Fair Isaac. They started out with this credit score matrix, which I'll tell you a little bit about. And they started calling it the Beacon Credit Score in the 50s, and it was used by, the first one was Equifax. There's Equifax Credit Bureau, there's Experian, and there's TransUnion. You probably really don't care. They are the three major bureaus. I don't know why there are three, and I've been in this business almost 40 years. I asked Mark not to say that, so we stuck with 30 years, and I have no idea. There are 1,000 credit bureaus throughout the country. They all report under the umbrella of the three major ones. And all of the financial institutions in the country use one or all three of those credit bureaus. Now, there's a lot of information contained in the credit report, and I'll get to that, but I'll talk to the FICO score first, and I'll get into the inquiries and how that affects it. FICO score range can be anywhere from 300 to 850. I've never seen an 850, and I've never seen a 300. I think even if you're not FICO driven, as we call it in the lending business, where that's the only thing you use, a 300 credit score is going to automatically eliminate you from getting any credit. That's about as low as you can get, and I'm expecting that everything in your credit report is going to show that you didn't make your payments on any loan that you have on the credit report, or it's been charged off and is with a collection agency. But that is the range, 300 to 850. I'm sure somebody at some point would say to me, what's a good credit score? A good credit score, 650 and above, is fairly decent, but it's not the credit score alone. There are other factors. You may have a 650 credit score or a 630 credit score because you don't have a lot of credit. You don't have a whole lot of credit history. So it's not because you have delinquent credit, which can also give you a 630 credit score. So when people look at credit reports, I don't like the FICO-driven or the credit score-driven lending process in and of itself for that very reason. Because there are a lot of factors that go into the credit score. And I'll speak to the question first, and that's inquiries. The number of inquiries can adversely affect your credit score. Absolutely. And the reason is that, and this is exactly the way it's put in the credit bureau, it's considered suspicious activity if you apply to a number of institutions at the same time, specifically for unsecured credit. It's almost like you're going to build up the money and take off. That's the thought. I mean, what's the rationale for applying to 3 or 4 financial institutions for $20,000 unsecured? That's $80,000 that you would have immediate access to. It's suspicious. It also, if you maxed it out, would drop your credit score from, if you applied and got it and your credit score was 650, it would drop it to under 600 because you have not only available credit, but you've maxed it out, which I'll get to in a minute. The law is written so that if there are a number of inquiries that are made and they're made within 7 to 14 days, they're considered one inquiry if you are looking for a particular product. So if you apply for those 4 lines of credit within a certain period of time, it's considered one inquiry. If you did it, and you have to watch that time frame very closely. It can be anywhere from 7 to 14 days. So you have to be very careful with the time frame. the way that you can get into trouble with inquiries beyond that is with an auto dealer. If you go to an auto dealer and the auto dealer wants to get you a deal as quick as possible, they will do what's called indirect lending. They don't give you the money. They get banks or credit unions to give you the money. And they have programs in their computers, and they shoot your application into the computer, and it goes out to 10 different lenders. And they take the best rate they can get for that day, and they offer it to you. And they say, here, we'll get you $299 or $199. That particular type of scattergun approach sometimes can fall through the cracks on this one inquiry rule. So you have to be kind of careful when you're going into a dealer. And if you go into a dealer and you just tire kicking and you're not sure you want to buy a car, and you decide you don't want to buy a car that weekend, but you've given them enough information to pull your credit report, and then you go back a month later and do it again, there's another inquiry and there's another scattergun approach. So you have to be kind of careful not to sign anything when you're just out there looking for a car in the spring and you know you're not going to buy anything. That's where the inquiries can get you into trouble. But there are some limits on them. The other thing is that there are what's called hard inquiries and soft inquiries. And the credit bureaus have both types. I can do a soft inquiry and it will show up as an inquiry where you can see that I've checked on you, but it has no impact on your credit score. By the way, that's what an employer's inquiry is. A hard inquiry is if you are applying for credit. Let's get back to the employer's inquiry because I think it's interesting. Because I am in the lending area and the human resources people are not familiar with credit reports, they will run a credit report on a potential applicant and they bring it to me or the collections VP, vice president, to review. And they will be looking for the repayment of debt as part of character. That's how people used to lend, was character, collateral, and the issue of character comes up. And I have seen upon a review of credit reports a number of applicants who are good in all other respects be declined for employment. So you have to be careful there. How many open loans or lines of credit will affect your credit score in a negative way? If you have 3 lines of credit with 0 balances, it will not have much of an adverse effect on your credit. If you have 3 lines of credit for $10,000 or each, or 3 credit cards for $10,000 each, and the maximum balances at that time they pull a credit report, the high balance and outstanding balance at the time is $9,000 on each one of them, that will adversely affect your credit report. You have maxed out your debt, and you owe a significant amount as far as the FICO scoring system goes. I'm using conservative numbers here. I've seen credit reports where people have installment and credit card debt that's unsecured, no collateral, in excess of $200,000. And I've even seen higher than that. I think the record I saw was $310,000. That's not a mortgage. That's not a car loan. That's platinum card, whatever you want to call it, visas, and unsecured debt. Amazing. And people are applying for $1.5 million homes based on a base salary of $100,000 and bonus income of $400,000, which in the last 4 years, if you took that application and it's gone from a base of $100,000 to a bonus of about $50,000. So, getting off on my lending side, so I don't want to do that. But, this one you should know: missed payments. You miss a payment, your credit score goes down. You miss 2 payments, your credit score keeps going down. You miss 2 payments on 2 different loans, your credit score goes down. And it's going to keep going down. And it's very difficult to reverse the process. Not of making the payments up, but of the impact it has on your credit. Just because you catch up on your late payments doesn't mean your credit score is going to bump back up to 20 points you lost, 20 points or so. People always ask me, well, how can I improve my credit score? And I don't mean to be flippant when I give them the answer, but it's don't let it get bad in the first place, because it sometimes can be a nightmare to reverse and get it turned around. And missed payments is probably the most significant factor affecting your credit report. So, and then there are people that just default and do charge-offs, which I mentioned. Do I have to explain that a little bit? Does everybody know what a charge-off is? I fall into the bankerese talk, and I don't want to do that. You owe us $10,000 and you default on your first payment or your second payment or whatever, and you stop making your payments. We call you and we can't find you. You move away, you graduate, I don't know, whatever you do, you join the military, whatever, you take off, and you don't pay the $10,000. We're stuck. We have to charge it off to profit and loss. And then we put it on your credit report. Outside of bankruptcy, it's one of the worst things that can show up on the credit report. And when you go back, after you say, well, I want to fix my credit report, and you go to a credit counselor, not a good idea, by the way, and they tell you to pay off your charge-off, it's going to take you a long time to increase your credit score by paying off that charge-off. So you don't want that to happen. And aside from a session talking about credit scores, there's another thing about credit counseling, and it's the whole idea here is not to get into deep debt, because that's what's going to ruin your credit score and ruin your credit. Couple of things about your credit score and your credit report that, well, the main thing that will have an impact on, and that is the decision-making process. Obviously, they're going to look at your credit report and make a decision whether to approve or deny your credit. If you have a low credit score, let me back up a second here. If you have a low credit score that's within a certain range with some banks, they will automatically decline your loan without any further discussion. If it's below 620, we will not give you a loan. Sorry, you're denied. Now, they have to give you one of a group of reasons under the Fair Credit Reporting Act for denying your loan, and that one would be that you have delinquent credit obligations or whatever drove your credit score down. Insufficient credit. So you can be denied. The other thing that comes into the decision is compensating factors sometimes. You have somebody, and I mentioned this before, you have somebody that has a low credit score, and it's not because of their credit or the payment of their loans, it's just that they don't have a whole lot of credit. Or maybe they did miss a payment, but there was a reason. I'm trying to think of a good example, because I also, in addition to doing, these are consumer loans. I'm sorry, should have mentioned that up front. These are consumer loans. We have mortgages over the other side. They're handled slightly differently, but the credit score still comes into play. But I'm trying to think of a reason.
What about like a divorce or something?
Yeah, I was trying to stay away from that. Divorce or job loss. How about that? Or a family medical emergency. And if I look at a credit report history where for 2 years people have been making their payments, an individual or a couple, they've been making their payments all along, and then from January of 2012 to June of 2012, there are blips. There are ones and twos, which means there are 30 days. One means 30 days, two means 60 days. They went without making their payment. I sit down with them, I say, something's wrong here. Now you have to be judicious and you have to be discreet and say, can you tell me, was there something that happened in this period of time? Because up to this point, for 2 years, you were making all your payments. And they'll say, I'm going through a divorce. Or my husband, my wife, my partner got sick. And that's a compensating factor. and again, self-promotion in the credit union, we would consider that was a letter from somebody stating that 6-month period, this is what happened. Or the real big one in this economy, I lost my job. Now I have a job, I'm back in the same line of work, and I need some money. I need a home improvement loan. We wouldn't be a credit union if we didn't consider that as a compensating factor. Yes?
I'll tell you real quick, one that happened to me as a student was I moved, and I called the credit card and gave them my new address over the phone, but they wrote it down wrong. And so then I didn't get the bill, and being a very good student, I didn't notice that I wasn't getting the bill until it was like a couple months later. And I called and I said, I'm not getting my bill. And they said, oh, well, we're sending it to, and they read the wrong address. And so that, happened. So I learned to put it in writing. If you're going to change addresses or any vital information like
Yes.
that.
And that happens more frequently than you think. Wrong addresses. And I mentioned first payment defaults. When we get someone who doesn't make their first loan payment, it raises a red flag. And we're like, something's wrong here. People don't usually do that unless they're setting you up. And we have a few of those occasionally. So we do some research, and that's the most common thing that we find. Speaking of that, even though you don't get your credit score unless you pay on the annual credit report, you should pull it and you should review it for errors and mistakes. I've heard all kinds of nightmare stories, and I decided I would not bore you with many of them, but a lot of them have to do with errors on the credit report between Social Security number being misplaced and you getting somebody else's credit, or junior and senior. That's one of the big ones. Junior and senior. Senior suddenly gets a credit report and he's got a bunch of credit on there and he's denied for a mortgage or a loan, and you give him the credit report to look at and he realizes it's junior. And that's a lot of fun when you hear him call him on the cell phone from your office. But there are a lot of things that can go wrong, so that's one of the reasons they allow you that free credit report on an annual basis. It's not just for the credit score, so you should investigate and check into it. I put down here how to improve your credit score, and I already gave you my answer that I initially think of when people say how can I improve my credit score. But the other way to do it is, over time, without even knowing it, if you don't pull your annual credit report and look at it, you can accumulate a lot of zero balance credit cards. Or you can think that you paid off a credit line that you had for $5,000 when it got to zero with your last payment, yet it's still open. So it requires a little bit of maintenance on your part to make sure that your credit report is accurately reflecting your financial obligation. Because even if you have a zero balance on a credit card or line of credit, it still is listed as an obligation on your credit report. And some places will take a percentage of your approved line and calculate it into what we call the debt-to-income ratio, even though you have a zero balance. Because you could come in and get a car loan one day, and then you could turn around and draw down $5,000 on the credit card or the line of credit, and your credit goes up, and how you are calculated for that loan the day before changes dramatically. So you want to clean up your credit report on a regular basis, and that would be annually. And I will tell you, it's not easy to get banks and some credit unions and other institutions to pay off your credit line, to close it out. They will do everything they can to keep it on the books, because they're out there mailing you these pre-approved credit cards, and that costs them a lot of money. Once they have you, they want to keep you. So you pay it down to zero, and then you write them a letter to close it out. They take their time. And you have to request it sometimes 2 or 3 times before they do it. And that outstanding credit line will affect your credit report. So be sure to do your maintenance work on that. always contact the credit bureau directly, because they are going to be the ones to solve your problem. It's not your bank, it's not your landlord, it's not your employer, it's not your cell phone provider, it's not Kohl's, it's not Target, it's not Macy's, it's the credit bureau. All of the previously mentioned institutions or people are just going to say, look, it's not me, we're just reporting you. We're reporting what we have. You go to the credit bureau first. If the credit bureau says that the information is this and you say it's incorrect, then you may have Macy's reporting something wrong. Then you go back to them, but you always want to start with your credit bureau. Okay? Excuse me. Any questions so far? Yes.
How long would you say it would take you to build credit? Like, say, like I was like just starting out or something.
Yes.
Like, to build credit where it would be like I don't know, that's,
Yeah.
but like have a long enough history.
Yeah.
Because like I know, like I've been trying to like build credit,
Mhm.
and I'm trying to get my own student loans or accepted from my parents,
Yep.
and it's still saying that like I don't have like enough credit history.
Yeah.
How long would you say? Like, or like, is there like a number or not really?
There's no number.
There's no number.
Yeah, there's no number. And that's where we get into the whole picture. So it's a good timing with the question. There is a school of thought that says what we call in the business 3 trade lines, which is 3 lines of credit. And I don't mean lines of credit. You may have a credit card, you may have an auto loan, and then you may have a line of credit. And if you have 3 of those, they're called trade lines. The school of thought is that that's pretty sufficient. I'm sorry. You looking for something?
I just wanted to let you know that the food and everything.
Oh, that's good. That's good timing. Okay. So the 3 trade lines, it's okay. If you have 1 trade line and compensating factors. So let me speak outside of the credit score a little bit more. If you come in to apply for a loan and I pull your credit report and you have had a $1,000 credit line, and I keep falling back into my banker talk. A credit line is you come in and you apply for a credit line and we say you can borrow up to $1,000 and then you can repay it in increments and then borrow it again. It's just revolving. Okay? So if you come into the bank or Bridgewater Credit Union and you have on your credit report a line of credit with Bridgewater Savings Bank, and you've been on a job out of college for 2 years, and you've lived in an apartment, or you went out and bought a condo, and you've lived there 2 years, those are, again, compensating factors. So you may not have 3 trade lines, but you've established some stability. And if you were applying for a minimal amount of money, and in this world, unfortunately, $5,000 might be a minimal amount of money if you wanted to buy a used car, we would consider the compensating factors. But usually 3 trade lines. And it would be like a $1,000 loan, a $500 or $1,000 credit card, and maybe an auto loan, but not necessarily that. Yes?
Does the credit limit, like the credit card limit that they give you, does that affect, like not your score, but like I have a credit card, but I know my limit's only $800.
Yes.
But I know that was because it was my first credit card.
Yes.
So do they ever do like reapply to like get it extended?
Yes, you do. Yeah, a couple of things. Are you asking if it's too low to have any impact on your credit? No, not at all. What they want to know is whether you have 800 or 8,000, how well you're repaying it. Okay? And yes, in most cases you do have to apply to get your credit line increased. There are other places where if you pay on time for a year, they'll automatically increase your line. But sometimes they'll increase it to a level that is beyond your capacity. So again, you get back, and I've hesitated using the word, but to discipline in your own finances, because that's what it's all about. You're going to get bombarded, even if you're not doing it already, once you graduate with a lot of credit offers, but they're going to be at high interest rates, as I said before. But no, the amount of the credit line is not going to have a negative impact if it's low. What I want to get back to, because I don't want to mislead people, I had mentioned earlier that number of credit lines with high balances will have a negative impact. I mean, you've maxed, again, I use the example, 3 $10,000 credit lines or Visa cards or MasterCards, and you're at 9,000, and you're going out and you're applying for a $5,000 personal unsecured loan. That's the same thing, the same category. The question is why? You're already maxed out. The thought is that you're going to use it to make the payments on the other ones, because you're robbing Peter to pay Paul. So, okay, I won't keep everybody. I won't keep people much longer. I'll answer any questions you have. But I did have one example, and I don't have the actual writing that I did here on it, but I calculated a 36-month, $10,000 loan that could be given an interest rate based on FICO scores ranging anywhere from 6 to 18%. And on $10,000 for 36 months, you could end up paying $60 more a month on that loan if your credit score is on the higher side. Because what I didn't really get into in depth, I mentioned it briefly, is that your rate will be determined in a lot of institutions by your credit score. So you can get an interest rate. You can get, when you see the interest rate as 0% from the Ford Motor Company for $169 a month to get a Ford Fusion or a Volt, then they have the fine print for 2 seconds and you can't even read it on the TV. What they're telling you is that you can't get that rate, because unless you have a credit score of 750 and above or 720 and above, we're going to charge you $699, $899, $999, $1,299. So pay attention to those 0% advertisements, because you're really, the minority is the group that gets those, and that's those people with 720 and above, or even in some cases 750 and above. Be very cautious. I'll touch quickly on something that can affect your credit for the rest of your life and will throw you into a nightmare that you probably won't be able to get out of, and that is identity theft. And I bring it up, and it's a subject I'd love to come back and talk to everybody about at length sometime, because there are so many problems associated with identity theft that I can't even begin to go into them. But if you are a victim of true identity theft, not somebody stealing your wallet and using your credit card or your library card, somebody stealing your name and your social security number and building up debt. And if you don't know that your identity has been stolen, you will suddenly find it out when you go to apply for something or you pull your annual credit report. And getting yourself out of that mess, because it is such a new crime, relatively new crime, is a living nightmare. They actually made a TV movie about somebody that had identity theft. Did you see it? It was awful.
It was a Lifetime movie.
Of course it was a Lifetime movie. I'm a junkie for Lifetime movies. I love the holiday ones. The cheesier the better. I'm sorry, Mark just found something out about me. Especially when they're, Christmas Town, where everybody dresses up all year round for Christmas. But it was a Lifetime movie, but it was a true story.
Yeah.
and the woman had her identity stolen. And it's absolutely impossible to get a turnaround because you tell people and they don't know who's talking to who, and it gets to be a very serious situation. That is a growing crime. And again, it is not somebody stealing your credit card and using your credit card. It's somebody actually taking your name, your social security number, your date of birth. Which leads me to one of the final things that I'll tell you. If you have documents of any type, and you probably already know this now, but when it comes to looking at your credit report, looking at your bills, even when you tear off the portion to pay the bill and you have the other section of the bill and you throw it in the trash, if you're not shredding it, you're asking for trouble. You are asking to be a victim of identity theft. It is becoming more and more common. They now have what they call a red flag identity theft program that was implemented under the FACT Act, and I know I talk like a banker, but another one of those regulations by the financial industry, on the financial industry, and this red flag is what literally, it waves a red flag. Be careful. This may be an indication, and it's a person comes in and does this, they do this, the patterns change in their checking account, the patterns change when they come in to change their address within 30 days of opening the account, or they have a post office box and not a street address. Those are what are called red flags, and they are indications of possible identity theft. It can ruin your life, and it can take a lot of hours away from your school time and your work time to resolve the problem. Okay? Just a couple of things I want to clarify when I was talking about types of loans, and then I'll ask for questions, and then you can all leave and hopefully a little bit more informed. They're unsecured loans. Again, that's where you don't have any collateral. There's nothing put up. You go in, you apply for a loan for $5,000, $10,000. In some cases, you get $30,000, $50,000, or up to $75,000 with no collateral, nothing, just on your signature and your 720, 750 credit score. They're secured. You can secure it with your own money. If you have $1,000 in the credit union and you've never had a loan and you want to establish credit, go in and apply for a $1,000 loan, put your cash up as collateral, make your payments for a year or 2 years, and you've established it. That's a secured loan. You borrow against an automobile, we perfect the lien. We take the lien on the automobile. We effectively own it. You are paying for it. You pay for it in full. We release the lien. It's your car, but it is in the interim secured by the automobile. You can also do that with boats. You can do it with trailers. You can do it with mobile homes. You can also do it with your primary residence or an investment property. Those are all secured loans. A line of credit, again, you borrow from it, you pay it down, you borrow from it again, you give it back, you pay it down. You can keep it at zero, and you still have $5,000 available whenever you need to borrow it. The best use of a line of credit, and the only one I think is really practical, by the way, is one that's attached to your checking account, so that if you overdraw your checking account, they automatically pay it out of your line of credit. That's a practical use of unsecured line. A Visa or credit card is the other practical use. My feeling is it's practical if you use it during the month and pay it in full before you incur any interest charges. So I thought I'd clarify some of the definitions and what I discussed. Are there any questions regarding what is credit? What is my credit score? What is a good rate on a credit card? A good rate on a credit card is probably anywhere under 10%. Again, because you're not putting up any collateral. That's why car loans can be offered at 0%, which you won't get, to 199, 299, 499, because it's secured by something. If you don't pay your loan, we take the car, sell it at auction, and get whatever we can for it. Anything on how many credit cards I should have? That's a good question. I think that came up at the last seminar that we did, mainly because they wanted to know how it impacted their credit report and the credit score. Again, the more you have and the higher balances you have, the more negative the impact will be. What makes credit score go up or down? I think I gave you the reasons for that. The main thing being if you don't pay your debt, and also maxed out on your credit line. how can I build credit if I'm just starting? And I think borrowing your own money or getting a co-borrower are two of the good answers. But also going to a place that will allow compensating factors. By the way, I use utility bills in a negative sense that they can show up on your credit report. We also use them for alternative credit. If you show that you've lived in an apartment for a couple of years, bring in your cable bill and your utility bill and show that you've paid them on time, that's credit. So we'll give you some consideration for that. Okay?
I know you mentioned that having like credit cards with zero balances. Like, not that they hurt you, but I mean, not that they help, but if you have a credit card that you only use like 3 times a year,
Yep.
would you suggest keeping it, or would you suggest to not, like credit cards that you use pay off one time?
No, there's no harm in keeping it. The harm is in the number that you keep.
Okay.
I think, again, the way I think it's balanced is that if the more available credit you have, and they're looking at the negatives here, so it's not that they're paranoid, that you can suddenly draw down all that credit because it's not secured by anything. You can go in and take a cash advance for $10,000. You can do it. You can go in on a line of credit and take $5,000. You have a check. You write a line of credit. So you can walk into a bank, credit union here, there, 5, 6, or 7 of them you have these lines with, and walk out with potentially $50,000, $60,000 in cash. The danger is what are they going to do with that? So why do they need all that money available? And if you do that, you're going to burden yourself with more debt. And if I have a car loan with you and you're paying me $175 a month, what's going to happen when you suddenly owe $50,000 on the unsecured? But there's no harm in having a credit card that you use 3, 4, 5, 6 times a month, or use at Christmas time and then in January pay it down a little bit. Again, the word discipline. It's the key word, yes.
Are cell phone bills considered the same as utility bills in the way that?
Yes, yeah. Again, we call it alternative credit or compensating factor. The compensating factor is you have no credit or you have not worked on your job for a long time, so how can you prove that you pay your bills? So you compensate by saying, hey, look, I don't have a store credit, a bank credit, but I paid my cell phone bill. I paid my utility bills. And that's, again, shameless self-promotion, how we do things in the credit union business. Credit union's a non-profit, by the way. Yes.
Say when you get married, we're engaged, and so what if I have terrible credit?
Yes.
He has great credit. How
Yeah.
does that work?
That is a great question. I once had a professor tell me, don't ever tell anybody they're asking a great question. It's condescending. I don't believe that. That's a great question, and I'll tell you why. Because we've had people come in and apply for car loans and mortgages as a couple, and it's interesting. Married couple, unmarried couple, whatever. And at that point, sitting across the desk, one of them finds out that the other's credit is awful. It's always fun. Again, you get to see people at their best. It does not stop you dead in your tracks, because all we do is say, okay, and you have to be very careful what you say to the people, because the other person may not know. But once you establish that one of you has bad credit, you turn it into an individual application. So you take you off of it. And by the way, if you buy a house, you can still be on the deed and not on the mortgage. And that's where we mostly find that it happens, when people, seasoned people and buyers of properties and automobiles, their credit is bad, someone doesn't know it, they come in, they apply, and they go, oh my God, that's an should I say OMG moment? Hey, I'm not that old, all right? Okay. And all of a sudden they say, what can we do about it? And we turn around and say, hey, it's time to say single applicant here. And that gets you off the hook. And there are times we can also consider joint income on a single applicant. It gets a little dicey, but we try to work with people to get over on the collection side. If because this sort of plays into the bad credit type thing. Our collections VP says there are two type of people that don't pay their bills. Those that won't pay, even though they can, and those that can't pay. He will hound the people that won't pay, and he will hound them forever to find out where they are to get them to pay their bills. The people that can't pay, he will sit down and listen to them and work with them and work out a solution to the problem. To make sure that they don't lose their house or their automobile because of that blip. Lost job, family problems, illness. Won't pay, can't pay. Two different things. So we work with people, and in that instance, that's a great question. I'm glad you asked it. I'm going to put it into my Q&A thing. So, any other questions? No? Well, thank you for coming out on a nice night, and I appreciate your time, and I hope you learned something. Thank you. Good night.